Welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appleman, founder and CEO of Appleman Properties. On this episode, we are talking to Veena Jetti, the founder and partner of Vive Funds, a commercial real estate firm specializing in conservative investment opportunities. Veena has over a decade of real estate experience and over $1 billion in assets under management. Veena brings expertise in targeting, acquiring, managing, and operating assets with cutting-edge technology and best practices. Veena, we're happy to have you on here today. If you could, just please let the listeners know a little bit more about yourself.
Hi, Josh. Yes, thank you so much for having me. Like you said, I started a company called Vive Funds. We're a large multifamily owner operator. We transact primarily in the Sun Belt plus Arizona. So Texas, Florida, Georgia, North Carolina, South Carolina, Arizona are our core targets as of right now. And we target those Class B value add assets with a really good story and a strong potential to return double-digit returns to our investors.
That's huge. Awesome. Why did you start Vive Funds?
Well, I started investing in multifamily because it was the best way to get to scale, right? And historically, if you look even like mathematically, right? So it's not just me being totally biased. Mathematically, multifamily has the best risk-adjusted return of any asset class out there. So both of those two reasons combined are a great reason to be in multifamily. And that's why I really want to be in multifamily. I started Vive because I wanted to be able to direct what I was doing. I wanted to have control over the assets that we were transacting on and what we were buying, how we were buying, what our strategy was, et cetera. So I really did it because I wanted to be able to put my vision into a company and be able to control that.
That's huge. A lot of guys, a lot of girls out there are watching. They want to get into multifamily. They want to get into the large properties, the 200 plus units, 300 plus units. And I know you're in some major assets, and you've got a lot of units under management. How did you get started, and then how did you? What was the journey for your path to get into the large assets?
Yeah, I feel like everyone always asks me this. And to be honest, when I started, I never thought I would be transacting on $100 million assets ever. I would have been like, okay, I think you're talking to the wrong person. But I started in single family investing because I didn't know you could skip single family. And I thought multifamily was only for like really rich people, like the Rockefellers, like I didn't know it was available to the everyday person. And when I discovered that, well, actually, first I bought like 5 houses in a week and was like, oh gosh, this is awful. And I hate my life. And there is nothing scalable about this model. And so when I first learned about multifamily investing, I was like, oh, that was like kind of like a light bulb moment. And so I started out by buying much smaller assets, but by partnering with people who knew more than I did and were like one step ahead of me. And so I would partner with those people. I kind of built up my knowledge base, my experience base, my track record. And then I continued on and eventually we scaled up. I mean, the first time we did a really large deal was amid COVID in 2020. We bought an $80 million deal. And I was like, okay, this is crazy. But here we go.
Yeah, that's huge. So you're a part of the general partnership. You've got general partnership, you got limited partnership. You're part of the team that manages the assets, work with property management, and work with the operators. And essentially, you're bringing investors into the deal and help them place their money in a solid asset that produces returns.
Yes, I actually am both because we invest as LPs also in our own deals.
Oh, that's awesome. So you're both sides. You get both benefits. That's perfect. Got it. What is your current investment criteria?
So it's funny you asked me this because we were just revisiting it yesterday. What we've done right now, it's 200 plus units, 75 million and up across the Sun Belt, 1985 vintage or newer, with a really strong preference toward like late 90s, early 2000s. But yesterday we were talking about it, and we're actually getting ready to switch up our criteria potentially because now we're implementing a lot of AI technology to help us target markets that maybe are wouldn't be something that we would normally target, but the numbers are there and the fundamentals of the market are really strong. So we could be changing that here soon.
That's amazing. So AI technology to give you a glimpse in what data is telling you that could be an opportunity on the horizon.
Correct.
Wow, that's incredible. So it's not necessarily a path of progress. It could be just any factors.
Yeah.
Something that's undervalued and markets are rising.
Exactly. That's exactly right. Usually we're in the path of progress, but there's now more data, and with AI technology being as robust as it is today, we can actually utilize that to be able to get a better cutting edge, I guess, insight on a market we shouldn't be overlooking that we might have otherwise overlooked.
Got it. That's a pretty good insight. That's good. What are the current underwriting trends that you're seeing? So now we're coming from, of course, buying based on pro forma, and that should come to surface here in the second quarter, I think, for a lot of operators.
Also,
but what are you seeing the trends out there right now?
I think a lot of talk and chatter right now is around the debt, right? So now we're not really seeing as many deals that are pricing out just in general because we can't get the leverage high enough on the asset. Two, now fixed rate debt is looking a lot more attractive than it was even over the last several years. And now we're seeing like Fannie and Freddie moving their loan terms or releasing new products that are a little bit more conducive to where the market cycle is. For the longest time, we couldn't see any deals that were levered above 50, 52, 55%. Now that's starting to soften a bit, and we're starting to see it maybe go to like 60, 65. But I think that has been like kind of a big shift. I think we're also going to start seeing an increase on insurance or not start seeing it. I think we're going to continue seeing the massive increase we've seen year over year on insurance, which, shocked a lot of us. I think during COVID, right before COVID, it was starting to climb faster than expected. But now I think that's going to kind of remain a trend here for the near term future. On the investor side or the equity side, what we're seeing is actually really interesting because our family offices and our more high net worth investors are pushing cash into multifamily right now. Our retail investors that maybe aren't, maybe they don't have like a whole team underwriting deals for them. They're a little bit more reserved and they're a little bit more, I don't want to say cautious, but they're a little bit more concerned. And so they seem to be sidelining capital, which is crazy because it's, for me, when we invest, we always try to follow like the wealthy people because we know they're vetting deals and they're looking at deals. So we like to follow the trends that they're following, and we're seeing them increase their interest in income producing assets. And it makes sense, right? Because it's an inflationary hedge.
Yeah. Yeah. And inflation, we see it coming down. Then we see the employment markets going up. We can't tell which direction the Fed's going to take things from one month to the next. So it's hard to underwrite really a solid exit strategy right now. It's just underwrite conservative and make sure the deal is producing cash flow. And
exactly.
it's the environment. But what advice would you give a high income earner looking to invest in real estate?
Well, if you're a high income earner and you like your job and you don't want to be doing real estate all day long, find a few great sponsors or operators that you like and you trust and you want to do business with, because this is a long-term relationship. It's not like okay, we're doing a deal today, I'm going to sell it tomorrow and never have to talk to you again. No, you're going to be in a relationship with me for possibly 5 years. So if you don't like talking to me, probably shouldn't invest with me, right? Like there's many sponsors out there. So find a sponsor that you like where their strategy aligns with what you're looking to do. Because the name of this game is really trusting your sponsor, trust but verify, right? Yeah. And so you want to have a sponsor or a handful of sponsors that you can rinse and repeat invest with. You don't need 1,000 different sponsors. You just need like 1 or 2 in every asset class that you're interested in investing in.
What is a deal sponsor? Just so we can make sure everyone knows out there.
Yeah. So you have 2 sides of the equation, right? You have your GPs and you have your LPs. Your LPs are your limited partners. Those are your investors. So if you're a high income earner and you invest $100,000 into one of my projects, you're an LP or a limited partner. That means you don't have any responsibilities, control, decisions, nothing. All your job is to vet me, the deal, decide you want to do it, and sign the documents, invest the money, and then you just collect the check. That's true mailbox money. For the other side of the equation, the GP or general partnership, that's where I fall. And that's how we go out and we do everything A to Z on the general partnership side. So we source the deal. We decide if it's even a good deal to go after. If it is, we negotiated, we go into LOI, we do the due diligence, we stack all of the capital. So we get the loan in place, we raise the equity, we close the deal, we execute the business plan, and then we ultimately sell it and hopefully make our LPs a whole bunch of money along the way. So that's the two sides of the deal, is the GP and the LP side, or the sponsor side and the limited partner side.
That's perfect. So I know that the real estate safe, it's brick and mortar, and I've got cash in the bank. I need to put it somewhere. And you would be a person that brings deals to the table that I otherwise wouldn't even know how to tell if it's a good deal or a bad deal. But you would be considered the sponsor. Is that correct?
Yes, that's right. Except one caveat is everyone was talking about like how safe an investment is. And I always like to point out to investors, there's no guarantees in this. There's still risk in any investment you do, whether it's multifamily or single family or new construction or the stock market, right? Like nothing is guaranteed. If you want a guarantee, you're going to have to go to like a government bond maybe, or go to, put in cash in your bank account, which I personally don't think is a good idea, at least not for my cash. But I'm not a financial advisor, so I can't tell you for sure, but there is risk in all of these. It's how we mitigate the risk that's more important.
Yeah, that's perfect. That's and it's uncovering those deals that you would never really know about. It's
exactly.
That's for sure. So a new investor wanting to get into real estate, or say a person who's an investor and he wants to become a deal sponsor, and get into the larger deals, what kind of path would you suggest that they start taking?
I think the name of this game is always partnership and collaboration. Finding a partner who's done like 1, 2, or 3 more deals than you have, so that they can help pull you forward. I also think too that getting in as an LP or a limited partner is a great way to start out, because what happens is you start seeing how experienced sponsors then communicate with their investors, what their process is. And you don't necessarily need to reinvent the wheel. It's already there for you.
Yeah, that's perfect. And then of course, getting into the right circles, the right people, the events, masterminds.
Absolutely.
It's all part of it. You learn from each other, and just learning the language.
Yes.
Perfect.
The mindset.
So, yeah, mindset. That's everything. It starts with you for sure. If someone wants to get a hold of you, invest into one of your projects, or learn just more about your fund and what you do, how can they get a hold of you?
So if you want to be an LP or limited partner in one of my funds, you can go to Vive Funds, VIVEFUNDS.com. And you can sign up in my investor portal. You can go on our mailing list. But if you want to learn about multifamily and you want to learn how to like sponsor and do what I'm doing, I have a free Facebook group. I just started it a few months ago, but it's called Mastering Multifamily with Veena Jetti. You just like fill out some questions. If you don't fill them out, it won't let you in. But if you fill them out, it'll let you in. And I do a lot of Zoom calls with like free training. So my Zooms are free for the first 100 people that show up. And then I put them all into my vault, which is a paid subscription where you can rewatch them or go back if you missed it. And so I put a lot of education out there.
Awesome. And then when we send out the recording and the podcast, we'll have your information in there as well, so that they can link right up.
Thank you.
Awesome. We definitely appreciate you coming on today, and look forward to talking to you in the future.
Thank you, Josh. I appreciate it.
All right. Thank you. Bye.
Bye-bye.